Thank you very much, Mr. Chairman. And I'd like to continue questioning concerning community banks, similar
Yes.
to Mr. Lukemeyer, because in Louisiana, many of the banking system are community-based banks, and they are impacted tremendously by the financial overhaul that we are looking at in the Congress. Madam Chair, can you provide me with the number of banks that have failed in Louisiana?
I do not know that off the top of my head, but I will certainly get it to you this afternoon when I get back to the office.
Okay, but probably it's either none or extremely few.
I would really need to check. I'm sorry, Congressman, but we've had I think we will have about 140 failures, and it's very difficult to know state by state. I will get that information back to you very quickly.
That's fine. The community banks in Louisiana, they did not involve themselves in the subprime mortgage mess. And as such, many of them were profitable in the past years, while some of the big banks have failed. My question to you here is, why are we making these small community banks who were successful, who operated within the boundaries of the traditional loaning criteria, they follow the rules? Why are we making them pay for the faults of the big banks through this tremendous overhaul process?
Well, I think two things. I think you're right. The community banks generally did not make subprime. They didn't make these high-risk mortgages. They did engage in commercial real estate lending. Some of that was not prudent. A lot of it was. They were good loans when they were made, but because of the economy, they're going bad now. And as the economic problems continue, more and more of the failures are driven by that. But again, banks must hold certain levels of capital and loan loss reserves against their loans. And if their loans are going to have losses that exceed their capital capabilities, if they become insolvent, or if they can't meet their liquidity demands, if depositors want to withdraw money and they can't have enough cash to do that, then they need to be resolved. And that is, again, there's a fairly well-defined procedure in our statute to do that. I think this Congress, again, back to the conversation about the appropriate use of TARP going forward and troubled asset relief, I think this is a ripe area, especially for smaller banks, to provide some assistance, continued need for troubled asset relief for the smaller institutions, and we'd be very strongly supportive. But our statute does not allow us to provide open bank assistance to large or small institutions, again, unless it's under this very narrow systemic risk
But it seems to me
exception.
that the small banks are being penalized for the actions of the bigger banks.
I think I am greatly troubled, and I have spoken out about this for a long time, of the different treatment between large and small. And the very large get the TARP money and get the support, and the small ones get closed. I don't like that. Going forward, I'd like to close the big ones too. I mean, I think that's really, if we're going to have a free market system, not a free-for-all system, but a free market system, I think going forward, the resolution regime needs to be able to work for small and large institutions, and right now it can only work for the smaller ones. But the immediate problem, you're right, it's not fair, and we have said that TARP we need to figure out a way to make TARP work better for the smaller institutions. And again, with troubled asset relief, not so much capital investments, I think that's a problem, but troubled asset relief, providing support there to help them get rid of these bad loans so they can make new loans. We're very supportive of that, and work with Treasury, work with Congress on trying to make those programs more effective.
Can you explain to me, I agree with you that the big bank institutions that were involved in the subprime mortgage loans, we need to have a better mechanism of overseeing their operations. But can you explain to me how regulating the smaller community banks that are already regulated by state law, how would that improve our country's financial health when they have been profitable, when they have been following the traditional methods of loaning? They would not involve or did not contribute to this financial mess. How would regulating them improve our financial health?
First of all, no Louisiana failures. My staff just handed me a note, so no failures in your state. I think we provide supervision, obviously, of small and large banks because they have deposit insurance. There's a government exposure there. If they get in trouble, we always protect the insured depositors. So with that comes prudential supervision, and that's been the case for over 75 years. I think moving forward, my concern from a supervisory perspective with the smaller banks is helping them diversify their balance sheet because of uneven, unlevel playing fields between large and small institutions, as well as between insured depository institutions and the shadow sector, the non-bank sector. Community banks have been relegated primarily to commercial real estate lending and small business lending, and they provide good support for their communities in those two areas. But they don't have much diversification. They got the mortgages taken away from them, a lot of the consumer credit taken away from them, and again, a lot of that has been driven through unlevel regulatory requirements. So going forward, I would like to see if we can change that to help them further diversify their balance sheet and get back to where we used to be with community banking, where they were in a position to offer a more full range of services to their communities.